Welcome everyone to our year-end tax planning webinar. My name is Marianela Collado. Most of you know me as Nella, if that's easier. I am the CEO and Senior Wealth Advisor here at Tobias Financial Advisors. And I often say I'm a recovering CPA. So this tax is what I love to do. And I'm joined here today with Lonnie, who's our Director of Tax and Financial Planning. So we're going to kick off today's presentation with a few tips on some year-end tax planning ideas. Please feel free to use the questions if you have any questions along the way that we can address during the presentation. And if we don't have time, we'll try to get to them at the end. But if you have any questions after that, we'd be happy to have a one-on-one or make sure that one of the advisors here at Tobias will reach out after the fact. So with that said, just a couple of things before we jump in. These tips are meant to be general. So if something sounds like it might work, it's better to have a conversation to ensure that it does make sense based on your circumstances. So these will be general ideas. And of course, we'd have to dive in to ensure that these are things that we can implement for you. Lonnie, any thoughts before we kick this off, or are you ready?
No, I mean definitely. Let's kick this off. As Noah mentioned, my name is Lonnie Sluchak, and I'm the director of tax here at Tobias. And I guess after over 2 years now, you can put me into the same category as a recovering CPA and getting into what we really like doing is adding value for our clients. And as Noah said from day one, this is where we make the magic in tax planning here at the office. So very excited to be here. And I guess a couple of housekeeping things as well. If anybody wants a copy of these slides, you can actually download them in the handout section on the presentation manager there on the screen. And if for some reason anybody cannot get those, feel free to reach out to us and we'll be sure to send you a copy of them. Again, so a little background about me. As I said, Director of Tax Services here, and I was in public accounting in a mid-sized CPA firm for over 10 years, and decided that whereas tax compliance is integral to the tax world, tax planning is another world, and putting the two of them together really is where, as I said before, the magic happens. So happy to be here with that and tell you guys how we do holistic planning at the office on a case-by-case basis. So with that, we can move on.
Let's jump right in, Lonnie. Why is this important, and why are we doing this now? Let's add a little color. Let's present our why, and then we can jump into some of the tips.
Right. Well, first and foremost, why are we doing this now? Everything is about timing, and a lot of these ideas that we're going to present today need to be completed before the end of the year to actually go into effect. And again, when you compare the tax compliance world where you're in February, March, and you see the tax documents and you see something was missed, at that point, a lot of times it's too late. It's already been missed. If we do what we're doing right now, we can hopefully catch a lot of these things and have it done. So when it gets into doing the tax return, A, we have an idea of how it's going to look, but B, these things are done and we can feel good that we maximize the tax savings for each client. So that's the timing aspect of it. And then the why, of course, is who wouldn't want to do something logical to save on taxes? I mean, we all want to do that. We all want to save taxes. And we're going to come up with some ways here today that we can actually do that. So, to that note, why is it so complicated? Well, every single client is different, number one. There isn't really any client that we say, oh, copy and paste and do that on the next client. Everything we do is a one-on-one type thing where we look at a plan directly and we figure out what's the best thing that makes sense for that client. And believe it or not, sometimes even if there is a tax savings, it might not make sense for another reason. So we have to really think about all the angles. And then aside from that, deal with changing tax rules and tax brackets and sometimes tax laws. Like, for example, there might be one that may or may not sunset in 2025, and we have to think about that. So there's a lot of factors that go into making a successful tax planning experience for the clients here.
Yeah, you'll often hear me say that if you don't do tax planning before the end of the year, we would need some sort of time machine in order to go back in time and implement the things that we want to change. Because all of a sudden, come April, and we're now hearing how much we owe, it would have been a lot of would have, should have, could have done this. So this is the time, folks, to think about what has happened throughout the year and what are little things or some bigger things that we can do to really move the needle on how much taxes we would expect to pay. But the one thing that I will say, which Lonnie touched on a little bit, we have to do this very thoughtfully, right? We don't want to shoot ourselves in the foot implementing one strategy but hurting something else. And we have to think about this on a multi-year basis, right? So we have to think about, what would be the impact to doing this year versus next year, and sometimes some of if we've worked with you on tax planning, is we're looking at this sometimes over a 10-year period if we're dealing with things like deferred comp or when to exercise certain stock options, right? So this is, we're doing this now because there's an impact to 2024, but we have to almost have a lens into the future as well. So jumping right in, our favorite topic, Lonnie, and probably the lowest hanging fruit that most people just don't think about. Let's talk about 401ks and IRAs.
Yeah, definitely. 401ks is something where it's just a great vehicle where you can contribute something pre-tax, reduce your taxable income, in the current year and let it grow. And the thing is that we always recommend our clients, if they're able to max out their 401k contributions on a yearly basis. To that note, when we're doing tax planning for folks, we end up realizing, wow, there's going to be a $5,000 shortfall on your 401k. And guess what? Because we're doing this ahead of the time here, you still have 4 weeks, 5 weeks, 6 weeks to make up the contribution and max it out. Might not seem like a lot, but if a $5,000 shortfall could be a couple $1,000s in tax savings. So it's just something that, like Nell mentioned, low hanging fruit. It's something that notably could get missed all the time, and we like to try to catch that. Again, we look at that in year-end tax planning. So pretty much with the IRA, on the flip side here, anybody that has earned income can contribute into an IRA. So again, even if you are not on a W-2 type job and you don't have a 401k through your employer, you still might have other vehicles that we can help you with to still put in money on an annual basis and save the tax in the current years. So it's a very important category here that, again, seems to get missed.
Yeah, and I'll add here a couple of things. Sometimes I'll hear people say, well, if I contribute more to my company sponsored plan, my paycheck is going to go down. So what about cash flow? And this is where we have to remove the blinders, right? So if we can take advantage of the employer provided plans or company sponsored plans, we can make up the cash flow from other resources. The tax savings are there for the taking if you do contribute to the 401k or potentially the IRA. We can make up the cash flow from another pot. I have some people refer to those, this is my pot of gold that I'm building for retirement. Are you saying that I might as well just reduce my pay, fully maximize my 401k, even if I have to replenish my cash from my little pot of gold that I'm building? Yes, that's exactly the strategy. So it's kind of thinking across the board, right? These are all pieces of your financial puzzle, and all we're trying to do is figure out how we can better place them so that you can magically have some tax savings. Another thing that I like to look at here is the mega backdoor Roth. Often overlooked. We just worked with a client for a couple of months. This was a huge undertaking where we had to fully revamp her company 401k to open up the opportunity to do after tax contributions. And most people are saying, after tax, isn't that Roth? Lonnie, what want to talk a little bit about that? Is Roth the same thing as after tax? What is this after tax?
Yeah, no, of course, and it's actually, I think you're a little bit ahead of the game. I think it's actually the next slide, but yeah, we're going to talk about Roth conversions and what a Roth is and what post-tax is versus pre-tax. And of course, the ultimate goal, the more that we can get into a post-tax Roth account, you're going to have tax-free growth as opposed to tax-deferred growth. And it's two both, nothing wrong with either. It's good to get tax savings in the current year if you can, and it's also good to have it grow tax-free and take it out tax-free at the time. So I think that there's obviously benefits to the Roth side of things.
Yeah, and then before we move on to the specific Roth, here's the number that I'm referring to. If you look at this 2024, 69,000 and 70,000, these are the maximum allowable contributions to a 401k. And maybe some of you are saying, where did that number come from? I've never heard that number before. I've heard 23,000 and plus the catch up, but what is this 69,000 you speak of? This is where the magic happens in this mega backdoor Roth. So if you currently don't know if your plan offers this, this is a good question for your HR department. And if you want to learn more about how the mega backdoor Roth works, let us know because we can walk you through the mechanics. But here's where some hidden magic is in your 401k. And I love what you said, Lonnie, about anyone can contribute to an IRA. And some of you might be saying, no, I make too much. That's not true. So I will repeat what Lonnie said. Anyone with earned income can contribute to an IRA. Now, you may not get a deduction, but this is what we'll get into. It's okay if you don't get a deduction because we're going to do something even fancier with it. So moving on to Roth conversions. And this is where Lonnie's going to add a little bit more color to that second part of first you make your IRA contribution and maybe you make too much so you don't get a benefit, but
Yeah, but you can convert it to a Roth, and it's called a backdoor Roth conversion. So again, obviously we want everybody to do its best in their individual situations, but a lot of times there's opportunities that present themselves to do this, and of course this is one that is it's almost a slam dunk for any client that has earned income that's in a higher income situation where they can go and convert to a Roth, and they'll have the basis from putting into a regular IRA as a non-deductible contribution, and then we convert that to a Roth, and we're able to do that tax-free. So it's really a magical technique that probably gets, I guess, another low-hanging fruit item now that gets missed all the time in client situations.
yeah.
To that, yeah.
Oh, I was gonna totally agree. What I will say about that is just be careful because if you're planning to do these backdoor IRA, not the backdoor, not the mega Roth inside the 401k, but these backdoor Roth IRAs, you just have to be careful that you don't have large IRA balances. So you'll often hear us say we have to clean these up so that we have the opportunity to do these backdoor Roths. So that's important. And the reason why a lot of people are looking at Roth conversions, yes, it's a way for us to remove our silent partner that we all have in our retirement accounts. And people are saying, what do you mean a silent partner I have in my retirement account? Yes, it's called Uncle Sam. So any dollar you take out of traditional retirement accounts, you better bet someone has their hand out waiting for their share of that pie that you've been accruing. So one way for us to get rid of Uncle Sam is through these Roth conversions. So we're going to buy out our partner. And the reason why we've been exploring that more and more is because of the changes in Secure Act. This is critical, right? Now, Secure Act doesn't allow our beneficiaries to take distributions over their lifetimes. So when we leave these large retirement accounts to our kids, they're going to have to pull it out within 10 years. So think about, a large 401k or IRA that we're leaving to our children and they have to pull that out within 10 years. That's going to be a pretty hefty tax bill. Or we can pay off our silent partner, get rid of them now via a Roth conversion, and then we're leaving a tax-free account to our children. I don't know if you wanted to add anything else to that, Lonnie.
Do the holistic planning here in the office, especially at year end on a client by client basis. Sometimes we see opportunities where the income was lower in a year and they're in a lower tax bracket. And, we have pretty sophisticated software. We can run projections and see an exact amount that can fill up the lower tax bracket. And you know, it's future thinking and all about timing. It's the theme of this of this webinar that we're going to talk about. But sometimes we need to think about the future generation, or we need to think about the next 5 years might have higher income, but this year in particular is less, and we can dump that much more into that Roth at a much lower tax bracket. That's the type of balancing job that we look at on each client on an individual basis. But I mean, again, who doesn't like the tax-free growth? So that's the name of the game with Roths.
Yeah, I love what you just said, because sometimes I'll meet people and they're saying, well, I didn't have to pay any tax last year. In fact, I had a loss. And then immediately my eyes open up and I said, oh my God, nobody told them about an opportunity to do a Roth conversion and actually pay off our silent partner with zero cost. So sometimes that's why the timing is so crucial, because if you already know that maybe if you run your own business and you're going to generate a loss, this is the year to look at that. That's a no-brainer. We don't have to run any
Yeah.
analysis to determine if we should do a Roth conversion, because it's costing us zero. So that's definitely one of those situations where no brainer. This should completely be evaluated to do it before the end of the year, but it has to happen before the end of the year.
You can't fix it after the fact. It's once it's missed, it's missed.
Yeah.
Yeah.
So moving on, charitable. So we talked about ways to chip away at our taxable income and ways to really boost our savings into tax-free accounts. But what about on the giving side? We have the pleasure of working with a lot of clients who are very charitable. And so this is a lot of fun. But let's talk about it, Lonnie. This whole bunching concept and why that's probably even more important this year than any other year.
Yeah, it's very important. And again, just like with everything else we're talking about, there's various factors that we have to look at on a client by client basis. We want to see, is a client already itemizing deductions, and immediately, no matter what they bunch, is going to be an immediate tax deduction, or it sounds like a great idea, but maybe they're $15,000 away from being able to itemize deductions. So that first $15,000 of the bunch donation is not going to mean much. So it might not be as good of an effective tax savings. So really, there's various factors we have to look at, but assuming this makes sense, we see this all the time, Nella. We see clients who are charitable and they want to give, and they give annually, and they give $2,000 a year to charity in cash, or $3,000 a year in
Oof.
charity, and they're just not getting any sort of benefit from it. They're getting the benefit of being good people and donating to a good cause. However, it's not helping them from the tax standpoint. Whereas doing something like this, maybe you take, hey, we're going to donate $2,000 a year for the next 5 years. Let's put $10,000 and donate it this year. Now you're getting the deduction in the current year, and you don't necessarily have to allocate it to the charity in the current year. It can go into this donor advised fund, and you can allocate this out in the future years anyway and do what you would have done. But now you got a tax deduction, at least in 1 year, versus 5 years of no tax deduction.
Absolutely. And so currently, we use Schwab, and we've been using Schwab more and more for a lot of our donor advised funds because they have such a low minimum. So it used to be that in order for someone to take advantage of this, they had to think about gifts upwards of 50,000, 100,000, 200,000. With much lower minimums, anyone should really be considering this. And I think Lonnie mentioned this, with the standard deductions as high as they are. If you're donating $1,000, it's not moving the needle. Yes, you might feel warm and fuzzy, and you feel good about what you did. But from when we put our CPA hats on, we're like, oh my God, it's a missed deduction. We didn't get a benefit. So this is where a donor advised fund can really come in handy, pairing your goals, right, your charitable goals and maybe your charitable commitments with making sure that these things are helping move the needle on the tax front. And then there is a way, Lonnie, for us to further enhance this. And by the way, let me just, another point before I move from here. I know with the results of the recent election, we may or may not see the Tax Cuts and Jobs Act sunset. Some provisions might stick, some might not. But one of the things that is in the provision today, which I don't know if they're going to allow it to sunset or not, today you get the full benefit of all your charitable deductions. There's no limitation, right? If you donate 100,000, you're going to deduct 100,000. If you all remember, those of us who remember life before the Tax Cuts and Jobs Act from a tax perspective, there was this thing called an itemized deduction limitation. So people who made more than 300,000 would get their itemized deduction sliced down, and they would only be able to deduct 20%. So that's currently not in the tax code today, in the Tax Cuts and Jobs Act, right? There's no limitation. If it sunsets, that's coming back. So that's coming back with a vengeance, right? So you thought, well, Nella, but if it does sunset, the top rate is going from 37% to 39. So maybe I wait and I donate in 2026 when the rate is 39 potentially. The problem is that also in 2026, if this is not extended, is the fact that there's an itemized deduction limitation. So if you donate the same 100,000, it's going to get sliced down to only 20,000. Oh, that thought of that just hurts. So this is another conversation with having with our clients today, that perhaps in anticipation of that possibly happening, if we accelerate a lot of these donations between this year and next year, we make sure that there's no limitation on our itemized deductions, on our charitable gifts, and B, it's time value of money. Now you're saving, if you're saving 25,000, I want the $25,000 saved today, right? Saved in my big, pot of gold growing and accruing for me. So that's just food for thought there. Okay, next. All right, how do we put a little steroids on that bunching, Lonnie? Let's talk about that.
No, of course. So taking it to another level, as she said. So donating appreciated securities is another step that we can really maximize what we're getting out of the donation here. So first off, you're donating to the good cause. Secondly, instead of donating cash, you're donating a security now. So how is this helping us? You're still going to get the tax deduction for the value of that security, but now you can avoid paying capital gains tax on the sale of that security, whereas before you would have done that. So this is actually a great graphic on the screen here that you can look at, but you have the current price of the stock, and you look down at the left scenario having to pay $7,000 of capital gains tax versus zero when you donate the stock directly to the charity. So overall, it's a $3,000 roughly higher tax savings. And this is something we see quite often, actually, and it breaks our heart. Like Nella would say, right? It's such a missed opportunity, because sometimes, well, how'd you donate that? Oh, well, I stole this stock, and then I donated the cash to the to the charity, and it just makes us cringe. So it's just one of those things where we need to think about this all before anything happens, and it's definitely helpful for us to be able to look in and see what securities might make sense to do that, because and Nella can definitely add to this from the CFP hat here, but this doesn't always make sense to do certain securities in this situation.
Yeah, for sure. It has to be long term. Okay. I've seen that where someone's all proud. Yeah, I donated these shares. And then I look at the statement. I'm like, oh my God, they're short term. It can't be short term. It has to be long term. And then sometimes I'll get the comment of, but I love my Facebook shares. I don't want to get rid of them. I want to keep it because I think that's still, it's still going to continue growing. So in that case, here's what I love about this. You were going to donate the cash anyway, right? Maybe you made a commitment to a hospital, university, and so we have to donate 50,000. You were going to donate the cash anyway. I would say let's go ahead and donate those Facebook shares that you bought years ago that are highly appreciated. Let's donate $50,000 worth of those Facebook shares. And then the cash that you were going to use to donate, we can buy the shares right back. There's no wash sale rules when you donate stock. And basically, what you would have accomplished is that you gave yourself a free step up in basis, because you're in the same place, right? You still donated your 50,000, but instead of cash, you did it in stock, and you replaced the Facebook shares with the cash that you were going to donate anyway. So that's just magically making tax liability disappear altogether. All right, let's see. Let's see. Get more excited now on the topic of securities. This is a fun one. And if I could just get that mouse there. There you go. This is one that if you all know Chad, this he does this year round. So what is this? What's the benefit? Lonnie, do you want to kind of kick off from a tax perspective? Tell us the magic of loss harvesting.
Yeah, and first off on that, the point that you made about Chad doing this year round, when I came into a financial planning wealth management firm, it was kind of mind blowing, because a lot of times you see this where, people do this once a year at the end of the year, and they maybe missed out on opportunities during the year. So it's actually maximizing the tax loss harvesting by looking through opportunities throughout the course of the year. But to that note, again, going back to the timing element of things, it's super important to take advantage of these opportunities when they come up. Again, you might ask, okay, well, you did tax loss harvesting this year, and now we have $20,000 of capital losses to carry forward. Well, it's forward thinking, because maybe we know that, you're going to need to sell a security in the next year and it's going to be at a gain, or maybe you have a big capital gain coming in from the sale of something else in your situation, and it's forward thinking. You want to take advantage of it now for later. And the reality of it is, with how these trades work, it's not at all hurting you in any way. You're selling something and buying something else, of course being cognizant of the wash sale rules and all that, but you're going through and doing a smart tax strategy here that you have for future use.
Right, and I think you hit the nail on the head, because we never want the tax tail to wag the dog, as they say, right? You have to think about the economics of it. So yes, banking the loss is great. I'm excited, right? You're going to pay $20,000 less this year because we harvested all these losses. But it wouldn't be smart if we did that and literally sat in cash and said, "Oh, I'm so smart. I just like sold that and I triggered all these losses and I parked my proceeds in cash." That wouldn't be smart, because that would defeat the whole purpose. The whole idea is that we're just banking losses when there's a temporary market downside, and then we're still invested so that those proceeds could still recover. And that's how markets behave, right? I was joking yesterday, I was talking about tax planning yesterday, and I said, no one's ever seen, the stock market just shoot straight up, without any volatility, without any noise causing turbulence, right? So it's just taking advantage of the fact that markets, they go down, they go up, they go down. So on those dips, that's where the magic happens. But I want to talk about another word on this slide, and it's gain harvesting. And you're saying, why would I do this? I've actually heard some planners say, well, if they're saying capital gains rates might go up, Nella, I'm going to just start triggering gains for the sake of triggering gains. And that just really made me break out in hives, because like, especially if we've done all these loss harvesting, I wouldn't be quick to start burning through them, because these losses become even more valuable later on. But another aspect of gain harvesting, which is something I do for my kids and I'm doing for my parents, right? There is a 0% capital gains rate. I don't know how many people were aware of the fact that there is a 0% capital gains rate. And so that is a use it or lose it, right? So if we don't fill up that 0% capital gains rate, sorry, it's done. It's not like you get to accrue it to next year. So what I'm doing for my kids is I'm filling up their kitty tax exclusion, and I'm triggering gains up to that 0% rate for them. And the same with my parents, as I'm going through their portfolio and thinking about how much gains can I trigger in their portfolio where they're in the 0% bracket, because all they have is Social Security and a small pension. So these are things, it's not just about losses, but also potentially gains. Okay, next. Okay, so another favorite conversation, another deduction above the line. Lonnie, let's kick us off here with health savings account, why we love them, how they work.
Yeah, well, first to start, since you mentioned, above the line, it's good for folks to note here that it's important to realize that even if you're claiming the standard deduction, you're not itemizing, you can still take this deduction for contributing to a health savings account. And it's really it's an incredible vehicle. I know different people have different feelings on how it works, but we at the office here really like offering this vehicle to clients and telling them the benefits of it. Well, first off, you contribute to it, and it's a 100% deductible contribution up to the limits, as which you can see on the screen here for 2024. They're up quite a bit. Self only 4150, or if you're on a family plan with the insurance, $8,300. So right off the bat, times your tax rate, you could be at a nice effective savings just on the contribution to this plan. But then it gets better. This is almost like we call the triple crown on this type of account here. So from there, now the money that you're earning in this health savings account, which by the way, most of these health savings accounts allow you to actually invest it in a portfolio. And now you're earning on this money you invested, and it's growing tax free pretty much. It's growing tax free. And to that note, the third part of this, which is really the kicker at the end, is, well, first off, God forbid you need it for medical expenses. Of course, you can take it out whenever you need on a yearly basis, tax free. But what we recommend to clients is, if you can afford to and your cash flow permits, leave the money in this account and let it keep growing. Contribute, invest it, let it grow every single year, but keep really good detailed records of all your medical expenses. And you'd be surprised if you keep a spreadsheet for the next 20 years of contributing into an HSA, you could have a couple $100,000 of deductions you can take out, or excuse me, of distributions tax-free at that time, with justification for all these years of medical expenses that you incurred.
Yeah, and most people get surprised when I tell them you should be saving all your receipts. Don't reimburse yourself now. Save it, keep growing it, invest it aggressively, and usually this is the little a pool of funds that we try to invest most aggressively so we can get the most growth. But you should still be saving every receipt. We have an app for our HSA program where my husband's pretty good about taking pictures of all the receipts and saving them, and it creates like a little log of all medical related expenses, so that in 20 years when we take $5,000 out of that HSA, we just have to click off, little medical receipts that we've been accruing. And sometimes some people will say, well, I just don't have the cash flow, Nella, like to really put money in here and not use it for current medical expenses. Even if that's your situation, still open it up, fund it with $1 so it's effectively like turned on. And then if you're going to have a procedure of some sort, having a baby or anything like that, then you already started the clock, and you can then just funnel those funds through your HSA to immediately reimburse you. At least you're running it through here, because if you pay for those out of pocket, it's really hard to get a deduction for medical expenses. You have to be so ill and accrue so much in medical expenses to really be able to deduct $1, because it's anything above 7.5%. If I'm right, Lonnie, 7.5% of your adjusted gross income. So most
Yeah.
of us won't really be seeing a medical expense deduction. But here through the HSA, you can almost ensure that you get that deduction and you get it above the line.
Yeah, and it's important to note, Nella, too, that you have to have a specific medical plan that's HSA eligible. I just want to notate that here, because not every employer offers an HSA eligible plan, and if that's not the case, then this isn't going to be a good vehicle for you. So it's definitely something, if you like this idea, you want to check and see if it's available and look at the plan documents and make sure that it would work for your situation.
And write that down. Make sure you check that it is HSA eligible. You could have a plan that has a high deductible, but it also has copays, and it's not really HSA eligible. So that's one thing. A couple of things: if you're over 55, not 50, they just want to keep things a little complicated for us, because they can use the catch up, the 50-year-old catch up for retirement accounts. They just, you know what, let's throw 55 so that, someone confuses this. But If you're over 55, you can then add another 1,000. And something that we often catch, Lonnie, and you can attest to this, is that people don't know if they have a family plan that each spouse is entitled to the catch up. So that would bring not only 8,300 that you can put in, but 8,300 plus one spouse's catch up of 1,000, and then the other. So that's going to get you all the way to 10,300 as an above the line deduction. And I like to say that this account, while we love it, it is also like Jekyll and Hyde. It is great while you are alive, while your spouse is alive, but it is not a good asset to leave to your kids, because then, the scary part comes out. It all becomes taxable if a non-spouse is inheriting this. So I do urge that while you're working, you're not fully retired, you're in accumulation mode. Keep saving, and don't reimburse yourself now, reimburse yourself later. But once you hit retirement, I would say like around 70 is a good time to just start then taking distributions from it. I don't know, Lonnie, if you have any thoughts on the timing of things.
No, that definitely makes 100% sense. And one other note on this topic too, because it can also be tricky from the standpoint if there's two spouses that each of their employers offer an HSA, and say one of them has a dependent on it and they have a family plan, the other one has a single plan. I think it's important to note that the total for the family is still the 8,300, assuming you're under the 55. Even if one's a family plan, one's a self-only, that's the total for the entire family, even if there's two HSA plans. So it's important to note that, because we've seen various situations, and we like to catch it in year-end tax planning, but sometimes if we don't do a tax plan or whatever the case is, we see it at the tax return, and now clients have to go in the cleanup mode because there's penalties and other issues for over contributing to an HSA. So it is an account you also have to be diligent to think out and be careful with.
And speaking of over contributing, we've caught this a lot where someone becomes 65 and then they're on Medicare, and no one has told them that they can no longer contribute. So that is the cutoff, 65. You can no longer contribute to HSA. So just be careful, because the cleanup it gets a little messy, right, Lonnie? And then all the penalties on top for excess
Yeah.
contributions. If you think you have a situation like that, let us know. I love cleanup. But I'm sure my team will kill me if I bring up a cleanup project now. All right, now, so you've tried doing all these things. You've maximized your 401k. You've made your donations, and you discover that maybe you didn't pay enough, Lonnie. How do we fix this now?
Your options start to get limited as you get later on in the year on how you can how you can fix an issue like this. But a couple of things that can be done. So if you're expecting, for example, a large year-end bonus, and it's something that you should tell us about when we're doing your year-end tax planning, we can model out a scenario with that bonus and see where it's going to put you on your overall situation. Maybe without you realizing it, it puts you into a higher tax bracket now because it's a large bonus, or whatever the situation may be. In that case, we might tell you need to withhold an additional amount of money from your W-2, through your W-2 before the end of the year to account for that. And why do we like doing it that way versus telling people, oh, just pay in an estimated payment? Because when you pay in withholdings through your W-2, the IRS looks at it as if you paid it in evenly throughout the entire year. And that's how you prevent that underpayment penalty. Again, another thing that we look at as far as IRA distributions, a lot of our clients are in required minimum distribution phase of their lives, and they're having to take out money every year, required amount. And we tend to, if cash flow is okay, tell them to wait later in the year, because we like to look at their situation in the holistic planning we do. And at that point, we can say, okay, we project that you're going to owe $15,000. You can take that out of your RMD, and IRS looks at that as if it's even throughout the whole year. So it's just being smart before the end of the year versus when it's too late afterwards.
Right. And a lot of clients, like, they're not really relying on their, RMD to live on. So this is the required minimum distribution. They're not really relying on that for cash flow. So this is why this is a perfect strategy. And you have to be timed correctly. I've had clients and Lonnie can attest to this, where we've had them stop making quarterly estimates because their required minimum distribution is so large that we can handle all their quarterly estimates at year end through withholding.
Yeah, quite a few clients like that, actually.
And speaking of required minimum distributions, Lonnie, one of our favorite tools.
Yes. So qualified charitable distributions, again, it's actually funny when we're doing these tax plans and building them for our clients. There might be one category that says if you withhold, this amount from your RMD, this is your situation. Then we always throw a scenario in. If you're charitable, donate directly from your RMD directly to the charity, and it opens up a whole nother avenue of tax savings to be able to, again, avoid the standard deduction versus itemized deduction saga. This is, again, above the line. It's directly off the RMD. You'd see it on your tax return. If it's done correctly, you see a little 3 letters QCD, and you'll see a taxable amount then that's less than the actual amount of the IRA distribution. And it's an important thing to note. We really like QCDs here at the office, again, if you're charitable, because it doesn't have any effect on the standard versus itemized deduction. And it's definitely a greater way of having savings directly. You're going to donate anyway. What I can say, a couple things on qualified charitable distributions is make sure you let us know about them first off, or your tax preparer, whoever it may be, and also keep good records of what's coming out of the account. Typically, it's actual physical checks that are coming out of the IRA directly to the charity. It has to come directly from the IRA, or we can't consider it as a qualified charitable distribution.
Exactly. Those funds can't make a stop in your account. It has to be direct. And I think Lonnie was spot on. The 1099 that you get from your IRA doesn't give your accountant any indication that you made a charitable distribution. So you have to make sure you're keeping track of it, or it can be forgotten. I've seen a lot of returns when we're doing our reviews where it doesn't say QCD, so someone didn't tell their accountant, and it kind of got lost by the wayside. All right, so now we've talked about taking advantage of retirement accounts and health savings account, and maybe we have some self-employed folks on the call, and they might be saying, I don't have these things. I have my own business. I'm a solo practitioner. How can I take advantage of these things? So these are great tools. We're not going to go in depth to each type of plan, but it's more of an FYI. If you are self-employed or have consulting income, you can still establish a retirement account for yourself. And these are like the basic level, but you can really put some steroids on these retirement savings plans. I'm not sure if did we lose the connection? Okay.
Here, can you
Okay,
hear me?
just making sure. Yep. Okay, just making
Okay.
sure. Because I just saw there was like an interruption here. But these are some basic plans you can implement if you are self-employed. And then if you are, we can layer some additional type plans where the contribution levels are much, much higher. So it's worth evaluating, but these things have to be looked at the end of the year, so we have time to put them in place. I don't know if you want to add anything to this, Lonnie.
Yeah, no, especially on small business owners, we like to look at this type of arrangement. I know we said earlier we were heavily talking about you have a 401k through your W-2 type employer. Well, you can also have ways of doing a solo 401k, for example, even if you don't have a W-2 or have an employer if you're self-employed. So there's a lot of things that we do in year-end planning to look at the tax benefits of contributing into a solo 401k or a SEP or some of these vehicles. And a lot of times it makes a lot of sense, but we have to look at it before year end so we know how to plan for it in the following year.
Correct. We're going to talk a little bit about wealth transfer. This has been a hot topic. Before, we saw the results of the election, the thinking was that all of these Tax Cuts and Jobs Act provisions were going to all sunset, and for sure the exemption level was going to drop. I still like that we proactively put a lot of things in place. So it's still worth a conversation. I think even for a lot of our clients, even before the sunset of the Tax Cuts and Jobs Act, they already have some potential estate tax exposure. So we're just going to remind you of some of the things related to wealth transfer. And please call us if you have any questions on this. It's smart to just kind of go through your balance sheet. What assets do I own? How is everything titled? What is the value of these things? Do I have assets in excess of $13 million? The exemption today is 13,610,000, and it is scheduled to go up for inflation again in 2025. But these are the things that should prompt you to do something. Do my assets exceed this level of exemption? And then if they do, what are things that I can do today to try to chip away at that, right? Is it better that the funds go to your family, next gen, or to IRS in the form of an estate tax? I would think it's better it goes to your family or charity, right? So think about paying tuition directly. When you pay tuition directly, it doesn't count as a gift. So most people forget about that, but it does have to be paid directly to the institution. And the same applies for medical expenses. If you have a family member that's ill and you were going to make a gift to them anyway, just go ahead and pay those medical bills directly, and those don't count as a gift. The other thing here that we love to talk about is 529 plans. It's not just looking at it as an educational savings account, but this could be more of a wealth transfer tool. And we're not going to get into that, but 529 plans, similar to HSAs, they're one of very few tools where you can put funds in there, and it grows tax deferred. And there's no required minimum distribution from a 529 plan. So it's a really powerful savings tool. And then if you do find that there's potentially some estate tax exposure, we could start talking about some more sophisticated strategies to try to mitigate that exposure. And the last thing I'll mention here is the annual exclusion. It is a use it or lose it. So we are all able to give up to 18,000 as a gift per person to our children, our siblings. And if you don't give your 18,000, you don't accrue it and double up next year. It's literally a use it or lose it. So if you find yourself in a situation where there is some potential estate tax exposure, taking advantage of the annual exclusion is super smart. Now, what I'll say is, again, not letting the tax tail wag the dog. You want to make sure that you've run your long range projections to make sure that you are in good shape. You are able to do all the things that you want to do before you start making gifts that you can't pull back. So that's the only thing I'll say is generally we do like a check. If we remove these assets from your account, how will this affect you over the next 20 or 30 years? Any comments here, Lonnie?
Yeah, it's just important to note that if you're thinking about making a gift, or if you're not sure if something would be construed as a gift, just call us or email us and talk to us about it. Because on the flip side too, sometimes we see quite often that a gift tax return was needed, meaning that there was a gift over the annual exclusion and the return was missed. And as Nella definitely attests to this, once the gift tax return is missed, it's harder to go back and fix a situation. So it's always better, if you're not sure, talk to us and we can figure out what the requirements are before it's too late versus after the fact.
Yeah, and I love that you said that, because unlike your income tax return, so pay attention, unlike your income tax return that has a 3-year statute of limitations, these bad boys are cumulative. So what ends up happening is that when we pass away and if you've made some taxable gifts, the IRS like almost does a reconciliation of all the gifts you made during your life. So it ends up catching up at some point, and some might say, I won't be here anyway, who cares? But it'll be somebody's problem to clean all that up. Maybe not mine, I don't know. But so on this, I want to bring this up because I just had a situation. Lonnie knows tax returns like to talk to me. I was just looking at a client's tax return, and she's currently going through a divorce, but just like going through it page by page, I caught something crazy. I basically, and this has happened, and I used to see it all the time when my husband had these stock grants. Because normally these stock grants, you might have like an exercise price to take advantage of your stock grant, right? And then the difference between your stock strike price and the fair market value generally makes it on a W-2. But what ends up happening here, and this is why I'm saying be very careful, is that when you do exercise those options, the custodian that's holding those shares, they don't realize that your basis is the full fair market value. So I just caught this on a return that's going to potentially save that client over $25,000 because the basis was reported incorrectly. So this is a problem probably across the board every time I see these being reported. But in terms of year-end tax planning, if you have stock options, this is the time of the year to try to determine, is it better if it's vested? Should I exercise now? Do I exercise later? Or if they're incentive stock options and maybe they don't have an income tax implications, but they have an AMT, an alternative minimum tax impact, this is the time to analyze that to see if you want to bring it forward to this year or push it to the future. So just food for thought. I'm not going to spend, we could spend 8 hours just talking about stock options here if we wanted to really nerd out here. But if you have this situation, it's probably worth exploring and looking at all of your options now. And then
We're
moving
running short
forward,
on time, but
I know.
it's important to add to that, Nella, too. Please keep all your documentation. A lot of times employers give certain documentations that look informational when some of these events happen with the stock options, and you might not realize it, but 10 years down the road or whatnot, those might be the things that allow you to see what the basis is or what a pricing should look like. And these can almost be like a wild goose chase to track down these documents after the fact. So if you're ever not sure, just keep it and give it to your tax preparer to keep on their file.
So we are running out of time. I'll just
Yeah.
want to mention here with regards to passive losses, just be aware if you own an interest in a real estate, a partnership, or some private investment, and perhaps it's not performing well, but you have all these like suspended losses that have been carrying over for years. This is the time to evaluate whether it's worth trying to dispose of that activity so that you can release all those losses. So if you have a big income year, the tax return tells you so much about all the opportunities available to you. So just be careful, because I've also seen where an activity has in fact been sold or disposed of, but for some reason it wasn't treated as such and the losses weren't released. So wrapping up, tax efficient diversification. This is all about asset location, and a tax return will also tell you if this is something that you should look at. If you're finding that there's a lot of ordinary income that gets pushed out of your portfolio, a lot of short-term capital gains, interest income, if you're finding that there's a lot of that, there might be a better way for you to position your asset allocation across different accounts to have a better after-tax rate of return. And it's something that we can evaluate for you. We're looking at that all the time. Like every year we're looking at what, marginal tax bracket do we expect you to be this year versus next year, and do we need to swap what we're doing on our fixed income side to make sure that you're getting the best yield on an after-tax basis. So with that said, there's some nuances for 2024. Nothing earth-shattering here. Here are the standard deductions for you to keep in mind. And there's some nuances. We'll just mention this, Lonnie. You want to talk about this because this is a huge thing that's taking everyone by surprise.
Yeah, I'd say so. I think that it's something that was huge in the beginning of the year. Then pretty much every state board of accountancy and all said it's unconstitutional. Nothing's going to come of it. And then all of a sudden, guess what? It's here. So definitely something. If anybody has questions, they can reach out to us privately, and we're happy to help guide them in the right direction. But inevitably, this is something that's going to affect all businesses and owners of businesses that are at least 25% shareholders. So it's something that's going to have a time frame that needs to get done pretty much by the end of this year, or if it's a new business within 30 days of the business being created into 2025. So The government needs to get more information from the taxpayers. This is a way of doing it, and the penalties are pretty steep. Over $500 a day for being late on these, and actually even criminal penalties possible in prison time if it's a known avoidance. So
Yeah,
definitely something where, yeah.
I don't know about you, but I don't look good in stripes. So definitely have to make sure of our beneficial ownership interest filings. So we are 4 minutes to time. I think we'll stop there and see if anyone has any questions. I'm not seeing any in the chat. If not, we'll try to cover some key points from the next slide and see if any questions come in. Um, Lonnie, were there any things here on the changes effective 2024 and 2025 that caught your eye? I have a few favorites here, but what about you?
About employers having to be required to automatically enroll the employers in plans. So, if you have employees and you're an employer that owns a business, it might be something you want to think about here.
One of my favorites, and it definitely caught my attention because I have three 529 plans for my three boys, is that if you have a 529 plan that you set up for your child or your grandchild ages ago, and it's been in place for at least 15 years, there's a new rule allowing you to do some Roth rollovers from this 529 plan to the beneficiary's Roth. Of course, that beneficiary has to have had earned income, and they can do up to 35,000. It's up to 35,000, but you still have to adhere to the maximum Roth IRA contribution limit per year. So that one definitely caught my eye. Another one that caught my eye is before, if you had a 401k, even if it was a Roth and you were past the RMD age, you still had to take required minimum distributions. So finally they said, well, what are we doing? It is a Roth, so no more required minimum distributions if it is a Roth 401k. We're not going to go through each one, but these are just the few of my favorites that caught my attention. And then with that, I'm not seeing any questions come in through the chat. We covered a lot. So if there's anything specific that you'd want more information on, please feel free to email us. We'd be happy to cover these things with you one-on-one. As you can tell, I can talk about tax over dinner, breakfast. It doesn't matter. I could do this all day. Lottie, any closing remarks?
No, it was a pleasure to go through all this with everybody, and hopefully we've sparked some ideas, at least in your minds, to give us a call. And I do see a note here in the chat. Should we just call the office for a tax planning meeting? Of course, give us a call anytime. Email us. We're happy to set something up and go through this with you.
Yeah, and we're reaching out to all of our clients to schedule those meetings proactively. But definitely, and I know Lonnie's going through all the plans now and sending everyone an email summary with everything that's customized for them. But if that's not the case, if you're not a client yet, for whatever reason, feel free to reach out and see if we can give you some planning ideas before December 31st. So with that said, thank you everybody for joining us. Have a wonderful afternoon.